Hello, everyone. My name is Jana Hanwerk. I'm affiliated with Fifth Avenue Financial, part of the MassMutual Financial Group. I'd like to commend and thank Terry Williams, the president, and Kevin Cohey, the chairman of One United Bank, for coordinating this event as part of the One Transaction Project and the mission of closing the wealth gap in the African American community. Today, I will be focusing on life insurance and how this risk management strategy is an essential building block and foundation of an overall financial plan. It is important to focus on education, empowerment, and enlightenment, and use the many financial instruments available, like life insurance, to create a process towards financial sustainability and security. My insurance career with MassMutual started in 1987. Prior to that, I got an MBA from Wharton in 1985, and I got my undergrad degree from Brown in applied math, where I had the pleasure of going to school with Terry Williams. So I've known Terry for over 40 years. As an independent agent with MassMutual, by the end of the summer, I had all my security license, so I became a registered investment advisor. This allowed me to be a comprehensive planner and be able to offer a holistic strategy for all my clients. Life insurance is a critical element in developing and implementing an overall strategy. Rumor has it, or theories show, that you're not a true agent until you've delivered your first check. I remember to this day, 30 years ago, when I delivered my first check to a dear friend that had passed away running 5 minutes from his home. After the funeral, I met with his wife, gave my condolences, and I delivered a check for $500,000. It was a very traumatic experience for the wife, but I was glad that I was able to help her and deliver a check. We sat down, we went through her budget, we looked at how this could impact and make a difference, and also stressed that she would not have to move out of her home. She could stay in her home. The girls could continue, they had 2 daughters, could continue to go to private school and on to college. So life insurance can make a difference. That's what we want to discuss today, the importance of life insurance and how the benefit of life insurance can create wealth, supply income, and also create a legacy for your family. Life insurance really boils down to what is your philosophy on life insurance. Do you want to just replace the income? Do you want to create a legacy? These are some of the things you want to think about when you're looking at life insurance planning. Is one, if you're just trying to replace the income, then you may need, 5 or 6 times your income. If you are trying to create a legacy, then you may have a much larger policy, and you may put that in a trust to get it outside your estate. So now you're creating generational wealth. That's another benefit that you're looking at. So not just the short-term income needs with a term insurance, but looking at the long-term benefits for the next generation so that you can basically have trust assets. And the goal is to make each generation stronger than the previous generation. So the first questions when you're looking at insurance is, one, how much do I need? That's really the first question. And that's done based on your salary, what you're making. The next question is, what type of insurance? Should it be term, whole life, or universal? That's next important. And then the final question is the structure, the ownership. Should I own it myself? Should my spouse own it? Or should I have it in a trust? These are all things that you want to consider when you're looking at insurance. You also want to look at, a question came up once before for me, other types of policies. There's a policy called a survivorship policy, which is basically on 2 people, the husband and the wife. For example, the policy would not pay till the second death, right? If after the first death, you need income, then a survivorship policy would not be attractive for you at that point. But if you have sufficient amount of assets and you're really looking at the life insurance as a long-term estate tax planning vehicle, then having a survivorship policy could be attractive for you, meaning that the death benefit is more going to your second generation, meaning for the children, and going into a trust. So it would not provide income right away, but it's really providing income on a secondary basis. What can you expect from your life insurance document? Again, this is a contract. And so after 2 years, the contestability period is gone, as I mentioned before. Are there conditions to my death that may null and void the contract? Like I said, the only thing would be the suicide prevention clause and also the contestability period. Can you have more than one life insurance policy? Yes, you can. When I started in the industry, anything under 100,000, you didn't need a blood and specimen. Now it's under 50,000. So for the insurance company to write a policy on you, they're going to send a paramed to your home, or you can go to a facility where they take a blood specimen, a height, weight, and one critical factor that they do look for is drug use. So if you have other than medical marijuana, but if you're using any other drugs, that could negate the policy totally. So you would not get the policy. Also, I've had a situation where somebody contested the results. Interestingly enough, one of the most critical areas that they can test that's most accurate is your hair. So they can do a hair follicle test, and it will tell you exactly when you used cocaine. They'll take your hair, take a strand of it, and they can analyze it and tell you if you said, I have never used cocaine. They can say that's a pre-existing situation, and they could null and void the contract. So tobacco use, drug use, alcohol, all those issues are what they call pre-existing conditions or factors that would make the policy more expensive for you. So you can look at numerous different insurance companies. Some carriers will only have a cap amount of, let's say, $1 million. You can also get a second million with another carrier, but there's a rating body called MBIA, which is they look at all your medical data, and it's out there. Anytime you've gone to a physician or any prescriptions, it's all there. And the insurance companies look at that on a comprehensive basis, and they check everything to make sure, again, that you're not everything is being fully disclosed. Life insurance always goes to your beneficiaries, income tax free, but it is part of your gross estate. A way to get around that is by setting up a irrevocable life insurance trust. By putting your insurance in the trust is the owner and the beneficiary of the policy. And this way, you're allowed to pass it on to your beneficiaries, income tax free and estate tax free. The other beauty of doing something like that is it also makes it much easier if you have young children, so that something were to happen to you and you had a young child. A child can never be the beneficiary of a life insurance policy. You can have a trustee or a guardian, but if it goes into a trust, it makes it much easier for the guardian or trustee. You can dictate from the grave how you would want them to get the assets. In my case, my children will get income for college. They will get money for a first home, but they're not going to get a lump sum that they can go out and buy 2 new cars. That's not going to happen. So it's again, a way to manage the assets efficiently. Also, if your child marries, this is a premarital asset, which keeps it separate on your side of the family, if that's so you wanted, or also for your children and their children. So it's, again, a very good planning tool for the long term. Another question that may come up, and you say, well, for a child, am I better off buying a 529 instead of a life insurance policy? That's a great question. That's actually one of the negatives of buying a policy on a child, is that in theory, the stock market may do better than the whole life dividend or the whole life cash value growth. But it's a complement. It's not a replacement. So you have a policy on yourself. You have a 529, which is invested in S&P 500 mutual fund, which will, in theory, grow efficiently and may outperform the internal growth of a whole life policy or a universal life policy. Again, these are not competing pieces, but they complement each other. Again, you're looking at a balanced diet, so there's no one perfect food other than kale, they say, but you still need to complement that with everything else. So again, the whole life policy on a child compared to a 529, the 529 may outperform, but again, the 529 has market volatility versus the whole life policy. The cash value has no market volatility, but the growth may be more conservative. So if you have $1,000, you might say, I'm going to put 500 into 529 and 500 in the whole life policy, so that over time they complement each other. The whole life may get you 3 or 4%. The 529 maybe get you 8 or 9%, and you may not, after all, touch the insurance, but use everything for the 529, so that by the time your child is in their 40s or 50s, now that policy, the death benefit, has grown significantly, and the 529 you use for college. And you want to also make sure, again, there's a lot of features now that people say you can go online and look online, and everything is way more accessible now. Before, in the past, you didn't have the wherewithal to fill in your application online. Now we have, because of COVID, you can e-sign everything online. So no one, people weren't going to homes anymore. Versus when I started out, you meet with somebody in their home or in their office. Now a lot of the tools are online, e-signing. The only thing that hasn't changed is you still need a blood and a specimen. You can't do that virtually quite yet. But again, you want to look and you want to say, is this going to make it easier for me? Yes, the industry is trying to upgrade and make it as easy as possible so that individuals can buy the insurance online without having to go into an office, and the e-signatures and all those different requirements, I think, are very important. A couple other important things to look at, like I said, I mentioned before, a whole life insurance company by a mutual carrier. If you're looking at a stock carrier, let's say a company that may have demutualized or is now a stock company, let's say Prudential, for example, which is a stock company. Again, the stockholders get the dividends. So they mostly do right now universal life policies or term life policies, no whole life policies. Again, the beauty of each policy has different features and benefits. With a universal life policy, the premiums may be cheaper than a whole life policy. The cash value is based on the current interest rate environment, not the value necessarily of the performance strictly on the insurance company, but on the interest rate environment that they're getting. There's also what we call variable universal life, where you have the capacity to invest in the stock market if you so choose, or index universal life, where it's tied to the S&P 500. So again, these are more sophisticated types of insurance products that are available to you. But again, they can play a role and complement everything else you're doing. Also, when you're looking at life insurance, you want to make sure that the carrier that you're buying the insurance from is a solid, high-rated company. AM Best is a rating body, and AM Best rates all the insurance companies that are out there. An A+ rated carrier is very important. All the major organizations, they rate companies, and that's easily accessible online to see who the top 10 insurance companies are. You don't have to be with a top 10 insurance company. There's still a lot of other good carriers, but you want to make sure that they have the financial stability, because remember, when you're buying a life insurance policy and you're 30 years old, you may not need this death benefit for another 60 years, or to life expectancy. For a male, it's around 82, for females around 85. So you want a company that has a strong track record, that's been around a long time, and is going to be for your beneficiaries when they need it 10 years from now, 20 years from now, 100 years from now. So that's very important. So you want to, again, do your homework, look online and look at the ratings of the insurance companies and what their track record has been. There's also two major different kinds of insurance companies. There's what we call a mutual insurance company, which is owned by the policyholders. And then there's stock insurance companies, which are owned by the stockholders. When you buy a whole life policy, it's important that you think of a whole life policy because mutual companies pay dividends, and the dividends are reinvested in your contract and helps your cash value grow. And it also can help you offset any premium payments in the future. So a mutual insurance company is critical. Stock companies primarily will write universal life policies more so than whole life policies. So again, you have term insurance is not as critical to be mutual or stock. Whole life, it's important that you have a mutual carrier, and there's some top-notch rated mutual carriers out there. New York Life, Northwestern Mutual, Mass Mutual, Guardian, those are top. Pacific Life, those are top-notch mutual insurance companies that have very competitive ratings and very competitive pricing. So again, you want to be able to do your homework and look online. You can get very good comparative analysis online that will help you make your decision. Also, when you're looking at your products on the insurance side, there are a lot of different ways that you can structure it. You can buy a whole life policy that you pay for your whole life, or you can buy a policy that you pay for 10 years, 20 years, or paid up at age 65. The lower the payment period, the higher the premium is going to be. An example is, if for comparative purposes, whole life is like buying your own home. Term life is like renting. And with renting, you have to change in 10 years or 20 years or 1 year, whatever that period is. Your landlord dictates. With whole life, you have more control. You can have, again, a 30-year policy, like a 30-year mortgage, or you can have a 15-year mortgage. So again, you're building up wealth, you're building up equity, which is very important. The cash value within a whole life policy grows tax-free. The dividends that you receive from a whole life policy, if it's reinvested in the contract, it's also tax efficient. If you take the money out of the policy, you're going to pay taxes on that. Similarly, if you have an account that you have in the bank and they pay you dividends or interest, you're going to get a 1099 at the end of the year that you pay ordinary income tax on. With an insurance contract, if you reinvest the money, you keep it in the contract. There's no 1099. There's no ordinary income tax on an ongoing basis. And this allows you to, one, minimize your tax impact, but also really create long-term wealth by not paying taxes. Currently, tax rates could be at 25% or 30%. Not having to pay that every year can be a tremendous value. One other important thing is your cash value, you have access to that. You do not have any penalties. It's just a phone call saying you contact or an email to your insurance agent or the carrier and say, I have $500,000, I have 10,000, I have 20,000, whatever that cash value is, you're allowed to borrow up to 80% of that cash value and use it to pay college funding, use it to pay a wedding, anything, use it to supplement your retirement. You have access to that cash value, which is critical, and no tax problems. It is a loan. So if something were to happen to you, you had a $500,000 policy and you took out 50,000, if you were to pass away, your beneficiary gets the difference. So you have a $500,000 policy, you've got 100,000 cash value built up. You ask your agent to send you a check for 50,000, doesn't matter what the cost is. They send you a check. If something happens to you 2 days later, then that amount that you withdrew is subtracted from the death benefit. And with a whole life policy with a mutual insurance company, your death benefit is going to grow over time. So you may have started out with a $100,000 policy, but over the next 10 to 20 years, it could now be, $150,000 or almost $200,000 policy, depends on the type of contract that you have. So these are some of the important things that you want to look at when you're structuring a policy. Again, term insurance when you start out has some features where you can convert it to a whole life. So you're starting out, your income's low, you've got a young family, you've got mortgage, you've got college debt that you're paying off. You say, let's start out with term. 5 years from now, you've just got a raise, your income's higher, your children now don't have daycare, they're in public school, you have more free cash flow. You can say, hey, let's think about maybe converting that term insurance to a whole life so that now I can start building up cash value. It's like when you first start out, you rent an apartment. Then over time, you say, hey, I want to maybe now buy a home. That's a process that you're looking at. And working with a financial advisor can help you and say, what does my career look like? What does my financial long-term goals look like? What are my short-term goals, intermediate-term goals, long-term goals? And how can life insurance help me meet all those goals and objectives through all those stages of your life? So you're starting out, you need a lot of insurance. You've got young kids. As you get older, you're more interested in building up the cash value that can help you assist you with your retirement planning, keeping the insurance in place for legacy planning. These are all things that you want to consider. So you have access to it without any reason, unlike an IRA where you can't touch it till 59 and a half, else you get a 10% penalty in ordinary income. The cash value, there's no penalty. There's no ordinary income when you withdraw the policy, the cash value out. Some new contracts also have what we call features and benefits. One is an accelerated death benefit. What is that? What does an accelerated death benefit mean? If you're in your 70s or your 80s and you've got a long whole life policy that you've had, now you have a chronic illness, the insurance company could give you up to 70% of the death benefit so that you can use that for your illness, chronic illness. They also have riders for long-term care. So you can have a whole life policy with a long-term care rider. So if something happens, again, the long-term care rider kicks in to help offset any long-term care expenses that you have, realizing that this may be subtracted from your death benefit. But again, if you have a critical illness or chronic condition like MS or cancer or whatever, your health currently is more important. And as long as your beneficiaries are aware of that and everybody knows, I think that's a very important tool to be able to use to say, one, I've got a benefit in there. A lot of policies also have features like what we call a disability rider. So it's almost like a different benefit within your life insurance policy. So again, if you became disabled, the insurance company will review it and they say, we're now going to pay the premiums on your behalf. That's called a disability rider. So you can have it on term insurance, whole life. So 3 riders to look at: 1, the disability rider; 2, the long-term care rider; and 3, the chronic accelerated death benefit rider. These are very important riders that when you're looking at your insurance strategy, do they make sense for you? You do have to pay extra for the disability rider. You pay slightly more, again, for the long-term care rider. And the chronic illness rider, a lot of companies, there's no cost to that because, again, you're getting the amount out early. The riders, as I mentioned, do cost. When you borrow from your policy, you do have to pay that loan back. If not, it's subtracted from your contract. And there is an interest rate charge for that loan. And usually it is the Moody's average industrial T-bill rate. So right now it's fairly attractive. Usually you're looking at around 3 or 4%. I've had clients that were not able to get a loan for their business or the down payment for their home. This is one way. Again, the rate is going to be maybe a lot cheaper than what you can get at the bank. It's more efficient because the insurance company does have your money. And so they know exactly what they're lending you. As long as you don't take out too much out of the contract, that allows, you want to be able to keep the contract in force. You don't want to take out too much that the policy collapses, right? What does that mean? Is if you take out too much of the cash value and you don't pay the premiums, then the policy could terminate. Versus when you have some of the contracts, they have what we call an automatic loan provision that if you forget to pay a premium, it would borrow against the cash value and pay the premium. So there are a lot of features and benefits when structured correctly, the whole life policy, really not just for your death benefit, but while you are living, there are a lot of benefits that you can get from it. One quick question also comes up is, can I get life insurance if I have pre-existing conditions? You can get life insurance if you have pre-existing conditions. It all depends on the severity of the condition. If you are a cancer survivor, they usually want to wait 5 years before you can have a policy. But after that 5-year period, they will relook at it. Other pre-existing conditions, they will look at, as I mentioned, cancer, high blood pressure, diabetes. All these things are important, and they will look at it. The policy may be rated if you have pre-existing conditions. What does that mean? If you're in great health, you will get what we call a preferred rating, meaning that's the best rating possible. If your health is average, you'll get what we call a standard rating. They also look at your driving record. If you have a drunk driving record, they're going to take that into consideration. They also take into consideration your family history, which is very important. Other things that they're going to look at is your lifestyle. What do I mean by that? Do you hang glide? Do you parasail? Do you do risk things? Are you a race car driver? They're going to look at all these things, and they may have what we call a clause that if you die because of those things, they could negate the policy if it wasn't fully disclosed. So again, life insurance, if you have pre-existing conditions, you may not get the best rating possible. You may get a rating, meaning you have to pay a higher premium, that somebody is in great health, has a great driving record, their height, weight is good. So again, it's not impossible, but it may cost you a little more to get that. We also mentioned overall estate planning, which is, I think, a good part of life insurance. So you want to look at that on an ongoing basis. Whole life insurance, as I mentioned earlier, has quite a few guarantees. I want to stress that in this low interest rate environment, some of the guarantees may be going down. Historically, they've paid around 3 to 4%, but in this low interest rate environment, some of the new products may have 1 or 2%. So it's important that you have an old product. That guarantee will never change. So the beauty of an insurance policy is you have the death benefits guaranteed. The dividends are not guaranteed. Dividends, like any dividend from any carrier or any stock or mutual funds, they're declared by the board of directors on an annual basis. So some of the top insurance companies in the 1980s and 90s, when interest rates were quite high, they were paying dividends north of 6%. Currently, like I said, companies now, the rates have come down. And if rates were to go back up in the future, some of the guarantees or the current payment could go up. So I want to stress that again, the dividends are not guaranteed. They're based on the performance of the insurance company. So I come back to make sure you're with a good company so that you're getting a consistent dividend on an ongoing basis, but also looking at insurance companies how they pay out their dividend is based on a couple of things. One, the amount of life insurance they have in force. Two, the investments that they have on their books and how it's performing. And then their mortality risk or costs. COVID-19, as you all know, last year has been a wake-up call for many about life insurance. This year, for the first time in the last 10 years, mortality has actually gotten worse. Historically, heart attacks or cardiovascular issues are the number one cause in death. So as a result, over the next few years, you can expect life insurance premiums will increase based on historical numbers, right? So that's important. So it's a wake-up call for everyone to, one, reassess where you are on the insurance spectrum and should you do any more. Because of the COVID situation, again, I mentioned mortality costs have worsened. Couple questions now that come up when you're buying a life insurance policy, not so much if you had COVID, but if you were hospitalized. That is the most important question, because I've had a lot of colleagues that had COVID. They weren't hospitalized. They had some symptoms, but not drastically. Obviously, right now, there are a lot of what we call symptoms that are longevity symptoms for people that were hospitalized. And so I think long term, that may affect the industry because we don't know the impact. Life insurance has been around for hundreds of years. A lot of basically carriers started, in the 1800s when they first wrote life insurance. And importantly, over the last 100 years, people are starting to live, much longer versus, in the 1900s, the average life expectancy was 50 years old. Now it's 80. So again, COVID, we really don't know the impact. They won't know the statistics for another 5 to 10 years. So the impact is, were you hospitalized and how severe were your issues? The other thing regarding the vaccine, there's no data yet to say, is the vaccine going to help or not help the insurance industry, because there's not enough data yet. We're just getting the data out there now this year, if you think about it. And I was an applied math major, so everything is statistically driven. In the industry, actuarial calculations dictate what rates are. And so I'm sure our actuaries are going to be looking at this very carefully, and that is going to impact the rates in the future as they recalculate what the mortality costs are and things like that. So it's an unknown right now in terms of how COVID could affect the industry. I think more importantly is really still cardiovascular issues. That affects the industry quite a bit, because still that was the number one leading cause of death last year, is cardiovascular. And the sad thing about that is a lot of times that is something preventable. What I'd like to do also is look at how this can impact, life insurance can impact closing the wealth gap, or looking at features that can help the African American community in a big way. Two things to consider. One is, a lot of times people in our community don't have significant amount of assets yet. So insurance is a great way to start creating wealth for your family over the long term. When you're doing planning, a rule of thumb is 10 to 15 times your income is a recommended amount of life insurance that you should have. How do we come up with that number? You could also look at your, what we call your human value wealth rating. For example, if you are starting out your career right now and you're making $100,000, but you have the potential to make $500,000 over the next 5 to 10 years, then you want to factor that in. When you're looking at just straight budget, if you say, if something happens to me, if I die tomorrow morning and our expenses are $5,000, $8,000 a month, then you want to look and say, if something happens, how much life insurance will my family need so that they can stay in the home, they can maintain their lifestyle without having to sell assets, without having to move or anything like that. So as a planner, when I meet with someone, we look at their budget, we look at what their expenses are, we look at how much insurance they have at work, what their assets are. If they have a mortgage, you want to look at that and say, hey, would you like to pay off that mortgage if something happened to you? And what are the ongoing scenarios over the next 5 to 10 years that if something happens, how will I be able to maintain my lifestyle? Realizing that even though you may be working now with one income gone, you may not have the capacity to continue to work as hard as you were if you have young children. You may want to be able to stay home for a year or two, if possible. And life insurance gives you that flexibility to be able to say, hey, I would like to stay home for the next 2 to 3 years or so with my young children, given that once one parent is gone, I want to be able to spend more time with them. And that's the benefit of life insurance, is saying, hey, How do I need to maintain my lifestyle for my family without having to move, relocate? When someone passes away, you don't want to make big decisions suddenly, like deciding, okay, I'm going to move to the South, even though it may be cheaper, because that's very disruptive for your family. So you'd want to be able to stay within your community where you have support. If you have family there, friends there, I think it's very important. So again, life insurance can help with that. Let's look at how a whole life policy can really impact and help the African American community. With a properly designed whole life policy as part of our overall plan, two things are important. One, your principal is protected. Your money, the money that you put in, the premiums are guaranteed, the death benefits guaranteed. If you compare that to a mutual fund, there are no guarantees in mutual funds. There's no guarantee in the stock market. Historically, the equity markets have outperformed life insurance. So life insurance is one vehicle. There's no perfect investment vehicle. When you're looking at planning, you're looking at life insurance as the foundation. You're looking at cash management. You're looking at bonds. You're looking at equities. You're looking at real estate. You're looking at precious metals. You're looking at art. All these pieces, all these vehicles are important in an overall plan. So there's no, when people ask me, Yana, what one thing should I get? There's really, it's like having a balanced diet. There's no one perfect vehicle. So your cash is king. Life insurance is important. You need equities for growth long-term. You need real estate also to build wealth long-term. You need bonds to minimize some of the risk. But the good thing about a life insurance policy is that the death benefit's guaranteed, the cash value is guaranteed, unlike other vehicles. So that's very important. You have guaranteed growth. When the market corrects and your stocks go down, your life insurance policy, the cash value will not go down lower than what the guaranteed rate of return says in your contract. That's very important to realize. What are ways to minimize your life insurance costs? Again, if you look at your health is one way, looking at term versus whole life, that's another way to minimize your costs. Also, look at if you have an employer-sponsored plan. If you look at a group plan, a lot of times companies offer their employees once their salary, twice their salary, even sometimes up to 4 or 5 times their salary. Group insurance is way more expensive than individual insurance, and that can be a terrific way to save money. The only downside on group insurance is that if you left the company, then that policy goes away. Or sometimes when you retire, it may go down from $500,000 to maybe going down to 50,000 or 100,000. So you have to realize, see what the requirements are and what the features and benefits of the policy that you have at work. So again, that can be a good complement to an individual policy, but you still are going to need an individual contract that gives you more flexibility, and it's based on your goals and objectives. So you have a group policy, you'd supplement it with an individual contract as a way to keep your costs down. And the group contracts, again, sometimes they have flexibility where you can have multiple times your salary. And usually you will not have to have a blood test or a medical exam. They may just ask you 1 or 2 questions. So the group policy can be a great way to minimize some of your costs. It doesn't discriminate racially. It does discriminate health-wise. So if you are in poor health, then yes, you are going to pay a higher premium. Are there features in our community that differentiates? The blood work's still going to be the same. The specimen's still going to be the same. So again, blood is blood, specimen is specimen. So it can't really differentiate necessarily based on blood work if you're an African American or an Asian. They can differentiate on other factors in terms of lifestyle and things like that. But overall, unlike, redlining for a bank or anything like that, there have not been any major discriminating issues recently. In the past, there were some issues based on types of contracts that were sold to African American communities, but that's way in the past. There's nothing like that Like I said, I've been with the insurance industry over 30 years, and I've never had any discriminating issues that I could say, they declined this person because they were African American, because they were Asian, or anything else. Every time someone's declined, it's because of their health. And so when I meet with somebody, I say, one, fast the day before you have your blood and specimen. Don't drink orange juice and have a smoothie before your blood, because that's going to throw off your measurements. If you eat a big steak dinner or eat a lot of different things like that, do it in moderation, so that, again, you want to make sure that when you have your blood and your specimen, you're fasted that morning and you get the best rating possible. So again, it's a beauty contest based on your blood work and your specimen, your height, weight, things like that. But in terms of your ethnic, racial, any of that, we don't care about that. We're not discriminating in any shape or form. None of the top carriers do any of that. There are a few questions that people always ask me about life insurance that I wanted to go through. One is, how may I approach, let's say, a parent or a grandparent and ask them if they have insurance? This can be a very tricky subject for older people. What you want to look at is ask them in an overall context. Do they have a will? Do they have a healthcare proxy? Do they have a medical directive? So come off very empathetic, not just saying that you're trying to get their assets, but you want to look at it and say, when you're speaking with your parents, and say, do you have any insurance that if something were to happen, for final medical costs and things like that? So again, you have to have an insurable interest if you were to buy the policy on your parents, or sometimes people buy policies on their partner, if there's a business partner that you can buy the policy on. So again, insurance is not just necessarily for your spouse, but you can have a policy on your parents, on your grandparents, on your children. And also if you have a business partner where you need a buy-sell agreement, if you have a banking relationship, and the bank may require that if you have a loan, that if something happens to either of the partners, then the life insurance policy would be paid off. One thing I would want to stress, which is very, very important, is every year you want to reassess your beneficiary. I have had situations, I'm sad to say, where a spouse divorced and they did not change their beneficiary, and the divorced spouse got the money. And it was heartbreaking. They asked me, Jan, I was going to send the form in. Well, you didn't send the form in, and we spoke about it and we sent them the form. But again, we will deliver the check to whoever is still the beneficiary. So every year you want to look and say, who's my beneficiary? Is it still the beneficiary that I want on this life insurance policy? As the children get older, you may want to switch them. Let's say if your spouse passes away and now your children are of majority, meaning they're over 21, they can become the beneficiaries. When they're not of majority, again, they can't be the beneficiaries. But this is very important. Again, I've seen it before where a business partner did not change the beneficiary. They wanted the spouse to be the beneficiary, and it went to the old business partner. So again, on an annual basis, make sure, just like your plans at work also, so in addition to your individual insurance policies, look at all your plans and say, hey, is this still the right beneficiary that I want? That's important, right? And again, if you have minor children, make sure that the custodian or the guardian is somebody that's responsible, that's going to help you manage that asset for your child. You have $1 million policy, and if you have it on a husband and a wife, they both should go to a trust instead of Aunt Mary. Aunt Mary could now be 100 years old, and she may not be able to handle that asset or whatever. And if you make it, an attorney or a bank, that may be even more efficient than, let's say, one of your siblings that may have financial issues. So again, the beneficiaries are very important, how you structure it, and make sure you do it on an ongoing basis. I'll throw out an interesting statistic. In the state of New York, there's $4 billion of uncollected funds because people did not have correct beneficiaries and someone passed away, and that small account, even on the insurance side, there have been insurance companies that after 7 years, if they have not found the beneficiary correctly, it goes to the state. So even life insurance and checking accounts, the insurance company does a very hard search trying to find, let's say if your primary beneficiary had already passed away, you did not have a secondary beneficiary, and who's going to get that benefit? And if you did not have a secondary or a trust set up after 7 years, by law, the insurance company has to send that to the state, just like any other assets. So a lot of states have significant amount of assets of uncollected funds, not just cash or not just 401ks, but also life insurance. So again, you've worked hard, you had the policy in place, you want to make sure it goes to the rightful beneficiary that you want. And again, not an ex-spouse or an ex whatever, but you wanted to make sure it goes to, your child. Or if you want, you can give it to a nonprofit. You can give it to your college of choice, or any foundation, church, you name it. A lot of wealth is created. I worked with some of the Brown and Columbia in terms of they get a significant amount of life insurance proceeds on an ongoing basis. So that's important to, again, check the beneficiaries and make sure that you're up to speed on an annual basis. And as your children, if you bought a policy on your child and you were the beneficiary, once they get married and have their own children, you want to switch the beneficiary to them, or even the ownership structure. You may have owned the policy in the beginning. Once they are financially secure, you can switch the ownership to your child. So those are some of the important features that you want to look at and say the ownership structure, the beneficiary structure, and also you can have a different premium payer also. Sometimes I see situations where companies are paying the premiums, or a grandparent is helping to offset the premium because of estate tax planning. So those are strategies that you want to look at and consider when you're doing long-term planning, how to structure it. And if you have estate tax planning concerns, right now under the current administration, taxes are going to go up. So insurance, because of the tax efficient nature of it, could play a bigger role in your planning with good structure, meaning that, again, the estate does not own it, but a trust owns it. The trust is a beneficiary. And if it's irrevocable, the trustee has to make the changes. So if you put your life insurance policy in an irrevocable trust, you are basically giving up ownership of that policy, and your beneficiary really does not have any say in that policy, but the trustees dictate that. I've had situations where under a trust, a child was to get income and they wanted additional money. And I said, no, we can't do that. You have to speak to the trustee. And again, the trustee has the wherewithal and the capacity to make sure that, again, the assets are there for the long term and not any short-term considerations. And remember, life insurance is still a life insurance vehicle. It's not a pure investment. It just assists in that. So if someone's selling you it and saying, look, you can get this investment, you have to look and say, how does it compare to everything else? So again, these are different tools. Again, it's one instrument that's important, has some different features. If you compare it to cash, you compare it to bonds, you compare it to stock market, you compare it to real estate. Again, all these tools complement each other and help the community build long-term wealth. And that's really what it's all about, is what are some strategies that can help the African American community build long-term wealth efficiently over the long term. So that's really what insurance is. It's a tool. It's one strategy. It's not the only strategy. It's a complement to everything else. It's a contract with an insurance company. that is guaranteed. The carrier is strong so that if something happens, it's there for you.